Hey, good morning. It's 11 o'clock on Thursday. Mike Wright here with Tax Right, and I'm the sponsor of the Red Shoe Business Club. I got all of my stuff done first, so I won't be dancing toward the camera again until I get done with this presentation. We've been talking about the things you can deduct, and we've spent 2 days before talking about one of the most complicated parts of deductibility, and that has to do with depreciation. We talked about what depreciation was. We talked about how you can have accelerated depreciation, straight line depreciation. We've talked about the existing special depreciation allowance. And yesterday we spent a good deal of time talking about Section 179 deductions based upon a depreciation concept, but that allows you to take up to $1.16 million of expenses as a 1-year deduction. These are powerful tools that a business owner can use to control the tax bill that they have to pay. It does require some planning, however. You need to be sure that you understand how these things happen and what happens with these things once those things happen. You'll also recall that the whole idea about depreciation has to do with capital expenses. Capital expenses are those expenses for items that last and are used over several years. One of the most common capital expenses that businesses have, in fact, there are businesses that are set up around these kinds of expenses, has to do with real estate. And real estate is something that many people utilize as a money-making technique, and they can even qualify to be considered real estate professionals. We've talked about that briefly elsewhere. I will mention today that just like other business, the existence of other kinds of business, being able to qualify as a real estate professional is very important for those businesses that focus on real estate as their business. And by that, I don't mean necessarily real estate agents. I'm talking about people who make their living by buying, selling, and renting real estate. But what I'm about, so that concept of real estate professional is equally important to be able to prove that you have a business, that what you're doing is not an investment, but it's actually a business. And so that's something that you want to be able to do. And part of the reason you want to be able to do that is because of something that I love this phrase, and I'm going to share it with you on the board. Passive activity. Talk about an oxymoron, something that is self-contradictory on the surface of it. But a passive activity is an activity that you engage in for making money that may be passive. Most stock and bond purchases are passive activities. They are simply items that you make money with, but you really don't do anything other than owning what it is that's bringing in the money. In the case of stocks and bonds, the government controls losses for passive activities by having a $3,000 a year limit on those losses. Now, if you lose $300,000, you can take off $3,000 a year until that $300,000 is used up, which by my calculation is about 30 years. But that's how they limit that. Why is it important to limit the losses from a passive activity? The reason it's important to do that is to prevent people from undertaking activities that they know will be a loser in order to offset income from another source and thereby reduce the total tax bill. This ability to remove, to deduct, to take off, exempt income, negative income from other sources, so as to reduce the total income that you pay, is a powerful tool that a tax planner like myself will find ways to utilize if it makes sense. But if we're talking about stocks and bonds, that amount is limited to $3,000 a year. When we're talking about real estate, however, it's a little bit more complicated. If your real estate holdings are simply investments, let's say you own a couple houses and rent them out, and then you decide to sell one of those houses, the same rules apply as to stocks and bonds. You have a capital expenditure, and so what you paid for to begin with, which is called your basis, what you paid originally. In the case of real estate, you can also include in your basis improvements. And you'll remember that yesterday when we were talking about Section 179 deductions, I talked about there are certain kinds of improvements that are eligible for that all at once write-off under Section 179. And then I also mentioned at that point that there are things that you need to be aware of when you sell that property. Well, when you sell a piece of real estate, you start out with your basis. And then you find out what you paid for the item or what you were paid for the item when you sell it. And the difference between those two is the profit, just like always. Okay, so it's sales price. Oops, can't spell. Minus basis equals profit. Now, in the case of stocks and bonds, the sales price or the sales price is what you sell it for on the market. The basis is what you paid for it originally, and that's a pretty straightforward calculation. Sometimes when there are stock splits and things like that, there are adjustments that have to be made in the basis to account for that, but that's the same logic. With real estate, however, you have to take into account the depreciation. Look, I buy a house today to rent, and 10 years later, 10 years down the road later, I sell the house. So the basis was what I paid for it originally. Let's just make this simple. Let's say we make no improvements. We've just owned the house for 10 years. But what's happened during that 10 years? Remember, I said that you cannot use Section 179 depreciation deductions for residential real estate. You can't use it for the main purchase of commercial real estate either. But let's stick with residential. So if you have that depreciation for 10 years, for 10 years, you have a depreciable deduction. Let's see if I can get some numbers based on this. We'll try and keep this simple because I don't have a calculator and I don't want to take too long to do this. But let's say we bought the house for $100,000. This is a tiny house that we, in 2013. Okay, so in 2014, we get the straight line depreciation. What was it, 27 and a half years? Well, whatever, 100K divided by 27.5, that's the depreciation each and every year. Boy, I should get somebody to calculate for me what that is. Hang on a second. Well, I should have known that off the top of my head. That's $3,636 per year. But remember, I told you that we used the half-year convention for the first year. So that means in 2014, we only get to take off 1818. Then in 2015, we get the 3636. 2016, 36, 36, all the way down the line until 2023 when we sell the house. So we have essentially $36,360 minus $1,818. So that's around, let's just to make it easy, let's say $34,500. So we have $34,500 in depreciation that we have deducted every year from our taxes. All of these years from 2016 down to 2023. $34,000 in advantages that we got for selling that house. Now, let's say that we sell the house for $250,000. We bought the house for $100,000. So our profit is $150,000, right? No, because we have already gotten the advantage of that $34,000 over the course of the 10-year period. When we sell the house, now we have to add back that depreciation. So we made $150,000 in profit on the formula of purchase price or sales price minus purchase price, but now we add back the depreciation, and so our taxable profit is actually $184,000. These numbers are rough. I did them in my head, and as you could see from my other calculation, I'm not real good at that. Thank heavens for calculators and computers. But the principle is what I want you to concentrate on here. Whenever you do real estate and you take the depreciation, you have to recapture that depreciation when you sell the real estate. Depreciation recapture is an important feature of any kind of real estate transaction that you do. And if you're a real estate professional, you're keeping track of those things as part of your planning for the real estate that you buy, sell, develop, rent, whatever it is you're doing with it. This is why this is part of the reason I believe that they do not allow Section 179 deductions for real estate, because of the complications it would throw into this very issue right here. And also with the idea that when that kind of real estate is sold, because inflation is so great over time, and typically real estate is owned for a long time, the amount of depreciation that must be recaptured is much higher. So these are important things to remember. I'll throw in one more comment about depreciation recapture. You cannot escape this calculation by simply telling the IRS, oh, I didn't take any of the depreciation when I did my taxes. I did not take advantage of that, because the rules in the law and the rules that the IRS has for doing this says that it has to be the depreciation that you took or were eligible to take. So one of my earliest tax deals that I did with someone had to do with someone that had a property that they sold, and we had this very concern, and because they hadn't done that, I had to do a lot of research to convince them that unfortunately they were on the hook for that depreciation recapture. The advantage so this is an important feature, but the other thing that you want to keep in mind is, remember the rule that we had about, let me get that other page up here. Remember this rule about $3,000 a year. If your income is not high enough to support the losses in the real estate business, the losses that you may experience, you have to have limitations applied to that. If you're a real estate professional, in other words, if you can justify the fact that your trade or business is in fact real estate, if you do that, then you can take those losses as ordinary losses. And that's a very powerful tool for someone who buys and sells real estate, because while what I just described this appeared to be creating additional profits for someone who over 10 years made that kind of realized amount, I want you to think back to 2008. And if you're not old enough to remember 2008, do some research about the real estate collapse in 2008. And you will see that the possibility of losing money in real estate big time is in fact very real. And so it's very important. So I wanted to talk to you today and focus strictly on this depreciation recapture, and focus also on the idea that this applies to everybody. So if you happen to be a person that just has a couple houses that you sell and rent out, and have bought and rent out, and then you want to sell them, you want to remember that this is going to be much more impactful than if you're a person who does real estate transactions as their business and maybe deals with 20, 30, 40 houses or units or more, and multiply how that would impact what goes on with your tax bill. The final bottom line point that I want you to remember before we close out for today is this. You have to remember the fact that planning is what saves your butt. All of this stuff is organized and stated in rules and laws and so forth. And so you can sit down and plugging in real numbers based upon your particular situation, you can plan what things will look like going forward with very close certainty. Yeah, there's always some loosey-goosey things at the edges, but with very close certainty, you can understand exactly what's going to happen and then make your plans accordingly. Tomorrow we're going to wrap up the deductions issue, and we're going to talk about the kinds of things that come about when you do things over time, when you borrow money, and how do you expense off that money, and what happens to the expense itself. We've talked about it briefly before, but we'll spend more time talking about it tomorrow. And if I get any comments from anybody or any other kinds of information about some additional information you want, we'll wrap that up tomorrow as well. So have a good evening.